So, you put in 10, in 15 years, you borrow out 2, and then your kids, they get 13 instead of 15. But that is like fresh Bitcoin for you. So we have people who have 5 Bitcoin, who some's in a hardware wallet, some's in a multi-sig, and then like they add us. We have people who have like 5,000 Bitcoin, and then they like buy a max policy. And different people are optimizing around their specific situation and their taxes and their estate planning and whatever the liquidity. But that is what the policy is: whole life, single pay or 10 pay, and you get these cool benefits.
A Galaxy or an Aave, because you don't have that liquidation risk because everything's Bitcoin denominated. Let's jump into where's the yield? How do you guys turn 10 Bitcoin to 15 Bitcoin over someone's life? And I want to hear more about that.
Yeah, I mean, fundamentally what we do is we have something that almost other people have in Bitcoin, but they don't tend to use, which is we have duration. That is, when you entrust us with your Bitcoin, you're entrusting it to us for a really long time. And I should say, because that is scary, that there's a lot of stuff we haven't. We have a regulator and we have an independent board in Bermuda, and there's a chief risk officer and an enterprise risk management framework. There's this external audit. There's tons and tons and tons of people who are checking what we're saying and doing. So unlike, I think, BlockFi or Celsius or for these people who have blown up, I spend a lot of my day on risk and compliance, and there's a lot of people who are sort of checking on this. Fundamentally, what we do is we lend to institutional counterparties Bitcoin, and we do that on an over-collateralized basis. And we actually do that for 2 reasons that it's over-collateralized, or collateralized or over-collateralized. One reason is we just think that's the right way to do it, and like the safe way. The other reason actually is when you run an insurance company, as I said, you have to you do all this math and you have to do all these solvency calculations, and we have to post our own Bitcoin. And every type of investment you have comes with like a cost, like a capital charge. And other than US Treasury bonds, which we can't buy because they're not denominated in Bitcoin, the safest considered asset is assets that we can classify as collateral loans. And that is, the collateral is worth as much as or more than the loans we do. So fundamentally what we do is we say, hey, we can lend to you for a year or 2 years when no one else would. I mean, these institutions can borrow Bitcoin. They do often borrow Bitcoin like overnight or whatever. We can offer is that term length. So you want to borrow Bitcoin for a year, you want to borrow Bitcoin for 2 years, we'll lend it to you, but we want a 100-page credit agreement. We want seniority. We want collateral. We want covenants. We want information rights. So we were talking before, like we've lent to a couple miners, and like their theory is, oh, I have Bitcoin cash flows. Like in the end, that's what I transform electricity, which I pay for dollars, but fundamentally like my cash flows are in Bitcoin. So we'll lend Bitcoin to them. They'll presumably sell the Bitcoin or like transform the Bitcoin into mining rigs or whatever, electricity. And then it's like a bond or something. Like we've lent them 100 Bitcoin. They pay us 5 Bitcoin a month for, I can't do the math that quick, but 5 Bitcoin a month for 2 years. That's only 60 Bitcoin. And then they pay us 45 at the end. And, we've gotten, in that example, which we wouldn't do, 2.5% returns. But fundamentally, that's the business we're in, is building a yield curve in Bitcoin, building debt capital markets, but doing so entirely on a collateralized or over-collateralized basis. And I should say all those numbers are low. Like we are not getting 7% returns or 10% returns or 12% returns. There are safe 10% returns in Bitcoin, in my opinion. To turn 10 into 15, our guarantees sort of look like 2% returns for our users. And then we get about 3% returns. And the difference between 2 and 3 is the business of being an insurance company. That is how we make money.
And Zach, when you're dealing with an asset like Bitcoin that just is eating the capital markets and is a black hole of capital, it seems like you're in a completely different insurance game compared to a normal insurance with US denominated debt and liabilities, but assets appreciating faster because of debasement. You're in a much harder game because you guys are all Bitcoin denominated. I mean, how often do you think about that? And also, like, do you see other groups that are large USD insurance providers coming into this space, or is it just so unique and more complicated because of the hurdle rate that Bitcoin already has built into it?
On the first front, look, it's harder in some ways and it's easier in others, right? In the harder, it is the Bitcoin rate of return, the Bitcoin hurdle rate. It's like all the rage right now to talk about this. Like we've been thinking that way for 3-4 years. But I want to go back to the very beginning and say, like, we believe there's going to be there is and will continue to be a growing economic system in Bitcoin. If there is an economic system in Bitcoin, there's going to be capital markets in Bitcoin, and there's going to be debt capital markets in Bitcoin, and there's going to be a yield curve, and there's going to be term lending in Bitcoin. And we think that's inevitable. And we see ourselves as both the recipient of that market, but also one of the creators of it. So I think it's hard, but in some ways it's easier, I think, to just think entirely in this new currency as a currency. Now, I can't entirely do that, right? I have to like pay my lawyers and my external auditor took payment in dollars. But we fundamentally think like when you're running a Swiss franc insurer, you don't ask yourself every day, what's the exchange rate with the dollar? It just doesn't matter. And that's the same. And then in some ways it's easier because so much of insurance is, well, one, it's boring and it's commodity and everyone's products look the same. But the second thing is that I think it's based on something that doesn't really make sense. By which I mean it's like based on fiat or based on things you can invest in with fiat. And because of that, life insurance products become needlessly complicated, like riders and like, okay, no, it's not a dollar policy. It's like indexed to the S&P 500. Unless, the S&P 500 earns too much and then it's capped or there's principal protection, blah, blah, blah. It's like so complicated. And it's complicated because I think the core value prop is confused, which is why I joke that like actually by having the hardest money in the world, we've been able to run a life insurance company like it's 1830 or whatever, it's the 18th or 19th century, because we're able to go back to the first principles of like, what is the real value prop? And the real value prop is protecting your family, doing so in a tax efficient way, and having this simple understanding with our policyholders, which is like, to use the numbers used before, like you give me 10 Bitcoin, I will promise that your loved ones get 15. And we all expect, or not we all, but like the people who buy the product expect 15 Bitcoin to be worth a lot more, right? So we start with this very simple question for many of our sales conversations, which is, would you prefer your kids got $1.5 million or 15 Bitcoin? And look, for many people in the world, the answer would be $1.5 million. They don't want the magic beans. But I think for people who like believe and bought in, the answer is obviously 15 Bitcoin. And we've built an entire company around it. I've talked for a long time on this question, but I'll answer your second question, which the second question was, do I think that big, historic, incumbent insurers will do this? I do not think they're going to do it alone. I have been surprised. This year is a very institutional year for Bitcoin, right? There's just so much institutional interest. And how that's expressing itself with us is we have received a ton of inbound requests to partner together to bring Bitcoin products to market. And we're happy to do that. Like fundamentally what we want to do is we want more people in the world to be able to save in Bitcoin. And if that means working with an incumbent insurer in the US or Singapore or UAE or whatever, and helping them do it, because we're the only like insurer in insurance land that can hold Bitcoin, then we're happy to do that. And if you had talked to me a year ago, I would have been like, one, I'm not partnering with these people, and two, they're never going to get around to it. And now what I think is they don't have the capabilities or the interest or the balance sheet to do it alone. But I think you'll see more and more Bitcoin life insurance products and annuities, but that is all going to be in partnership with us.
Makes complete sense. And as you keep on referring to this Bitcoin circular economy that is existing, as you succeed with this one product, what other financial primitives or insurance products will you guys move out to? Or is it simply, we want to be the best at this product and we don't want to get into annuities or pensions or reinsurance?
Oh, no. Basically, we're interested in doing everything that an insurance company does that is genuinely long-term. And by long-term, we are really focused on like a year, which may not sound super long-term, but our whole life product like obviously lasts 40, 50 years. We're planning next year to do a fixed deferred annuity, which is just like a savings product. You put Bitcoin in an account and it's like compounding, let's say 2% a year, and then you can withdraw it during your lifetime. Again, very tax advantage. We're working on a product now called the Guaranteed Investment Contract, which again is like a certificate of deposit with an insurance company instead of a bank. So that would be a way for users or institutional counterparties to, I was going to say, it's so funny. Okay, for banking, I'd say a certificate of deposit. If you're like from crypto land, I'd say like you can stake your Bitcoin, by which I mean we will invest. You can entrust us with your Bitcoin for a year and we'll go get a yield on it the way I mentioned. Yes, reinsurance. There's this whole category of stuff called company-owned life insurance, which isn't like the group life you might sign up for in your payroll, but is like literally companies buy life insurance on their employees or put it in pensions or deferred compensation plans. We intend to do all of that. I think the things that, it's funny, come to mind the fastest for people is often term life, because it's like the most common product. That'll probably be like one of the last things we do. And primarily that's for two reasons. One is the idea of term life is it lasts a certain term and you're very unlikely to die in the term. But if you did, it would be like terrible. So you pay a little amount and then you get a really big payout, right? So I pay, for example, maybe like $1,000 a year and I get, I don't know, $1 million or $2 million in coverage. So the reason you do that is if you're like youngish and if you get hit by a bus, that'd be really bad. And so you buy this term life. But there's two reasons we don't like that. By the way, you should buy term life, but we don't like it for Bitcoin. One is if you are one of the unfortunate people who dies inside the 10-year term, the price fluctuations of Bitcoin are quite up and down on that time scale. And we really want to push users to think, or policyholders to think in that 20, 30, 40, 50-year time span. Whereas if you bought term life, your family really could end up in the situation where like, oh, we happen to be where it is in the cycle where Bitcoin's worth a lot less than you paid. Whereas I think as you go over time, we feel much better that like, okay, we're actually going to be getting our users much more purchasing power than like when they bought the policy.